Having talked about all of the cash flows over the life of a project from a theoretical standpoint, what we're going to do now is create an example, and we're going to go through all of these cash flows, build up all of these cash flows, and then these are the cash flows that we'll use as we talk about the payback period and net present value as well, just to make certain that we see how all of this goes throughout the process. So here's our information. CMA Products Inc. is considering the purchase of a new piece of equipment to introduce a new product line. The equipment will cost $125,000, including setup costs, installation, and testing. The estimated before-tax annual cash flow from operations is $50,000, and the investment will require an initial investment in working capital of $25,000. The estimated salvage value is $10,000, and CMA has an effective income tax rate of 30%. And what we're going to be doing here is we're going to be doing full tax depreciation as part of this. So the information that we need for that, the equipment will have an economic life of 9 years, but will be depreciated for tax purposes over 7 years using makers. The makers' depreciation rates for each of the years using the half-year convention are as follows. And we have percentages here for 8 years. A couple of comments here. Remember, with U.S. tax depreciation, salvage value is not taken into account. So at the end of the depreciation, the book value, the tax basis for the asset is going to be 0. It has a 7-year useful life, and we have 8 years of depreciation here. That is because makers uses, as it says, the half-year convention. So in the year of acquisition, we take 6 months of depreciation, and in the year of disposal, we take 6 months of depreciation. So years 2 through 7 are each a full year of depreciation, and years 1 and 8 are half-year depreciations, which is why year 1 has a lower percentage of cost than year 2 does, because year 1 is taking into account only 6 months worth of depreciation. So that's the information that we have and that we need. We have information about the initial investment, we have information about working capital, we have information about the depreciation rates that we're going to have, and also what that benefit to the company is going to be each year in that $50,000 cash flow from operations each year. So what we need to do is we need to go through and calculate the cash flows that we're going to use for each of these items that we've been given, and then we're going to put that into a table to kind of bring it all together. So we start by looking at the net initial investment. There are 2 cash flows. We have the net initial investment in equipment of $125,000, and we have the initial investment in working capital, which is treated as a cash outflow of $25,000. Now we see there was no old equipment to be disposed of, so we can just put a 0 in for that. But what we have is a $150,000 net initial investment. No tax impact here. There's no tax impact connected to the working capital. And the tax impact connected to that initial investment in equipment is going to come out every year as part of the tax depreciation shield. Okay, so $150,000 cash out the door as our net initial investment. But then every year during the project, we're going to have cash flows from operations. Now, there's different ways we can calculate the tax. It's not a difficult calculation, but this is just the tax, or the cash flows that do not include the effective depreciation. This is just the cash flows from operations. We have $50,000 before tax cash flows, and we have a 30% tax rate. So however we want to do the math, the 50,000 times 1 minus 30%, we have $35,000 of net cash inflow per year after tax. And it's that after-tax number that we care about. So we've got $150,000 out the door at the beginning, and $35,000 coming in every year from this project. Now the next calculation is the tax depreciation shield, or the depreciation tax shield. Now we've got all the calculations here, but what we're doing here is very simple. Remember, the amount of the depreciation tax shield is 30% of the tax depreciation amount each year. Well, the tax depreciation amount each year is $125,000 multiplied by that makers percentage that we were given in the table. And if you have to use makers in a question, they're going to give you the numbers in the table to use. So for year 1, it's $125,000 times 14.29%. That is the tax depreciation expense. And we multiply that by the 30% tax rate. So the tax depreciation shield in year 1 is $5,359. In year 2, $125,000 times 24.49% gives us the tax depreciation expense. We multiply that by 30% and we get $9,184. So over the life of this project, we will have $125,000 of depreciation expense allocated over those first 8 years. And each of those depreciation expenses multiplied by 30% gives us the depreciation tax shield each individual year. Notice in year 9 there's none, because the asset is fully depreciated at the end of year 8. So in year 9 there is no tax depreciation expense. Since there is no tax depreciation expense, we don't have any tax savings connected to that in year 9. At the end, we've got a couple of cash flows. We have the after-tax cash flow from disposal at salvage value. So we received $10,000. The gain on the disposal is all $10,000 because the tax basis is zero. The asset is fully depreciated. And under makers, we don't take into account a salvage value, so it's depreciated down to zero. So we have $10,000 cash received and a $10,000 gain. And we have the pleasure and privilege of paying 30% taxes on that $10,000 gain. So that's $3,000. So our after-tax cash flow from the disposal of the asset in year 9 is $7,000. Okay, $10,000 cash in from the sale, and $3,000 of that gets paid out in the form of taxes. Now also in year 5, the working capital is released. And so that release of the working capital comes back down. $25,000 is treated as a cash inflow. And just like there was no tax effect when working capital went up, there is no tax effect when working capital goes down. And so there's no tax effect here. And so that's treated as a $25,000 cash inflow in year 9. So we take all of those cash flows and it comes together in this nice little table. We have the initial investment, $125,000 out. Working capital, $25,000 out at the beginning, $25,000 in at the end. $35,000 after-tax cash flows from operations every year. We have the depreciation tax shield, different amount each year. But we made those calculations. And then we have the cash in, the net after-tax cash flow from the disposal of $7,000. And in the bottom line, what is the total after-tax cash flows each year? At the beginning, $150,000 out. Then we have how much net cash after-tax cash flows we have coming in every year. Notice at the end we have $67,000 in year 9, the biggest year of cash inflows, because that's the release of the working capital. We have the gain on the sale of the assets, that when we sold it at the end, as well as that ongoing $35,000 that we have every year from our operations. None of these are individually difficult. Okay, to calculate the initial investment, not difficult. The increase in working capital, not difficult. The cash flows from operations, not difficult. And really, the depreciation tax shield isn't difficult. It's tedious, perhaps, and a lot of numbers, and we have to make all of those calculations correctly, but 125,000 times a rate times 30% is not difficult. It's just a matter of doing it, and doing it without making any mistakes, and then adding these up. So this is how we calculate each of those individual cash flows. And as I've said, what we're going to do is we're going to use these cash flows as we look at the different capital budgeting methods, kind of carrying this example through that. But we've looked at those cash flows and calculating those cash flows theoretically. Here it is that we have them with numbers. And again, one more time, you have to be able to do this. There will be questions on your exam that either require you to specifically calculate one of these cash flows, or to calculate one of these cash flows and then use that number doing something else, putting it into a larger question. But you need to be comfortable with calculating these cash flows, understanding the tax impact of the different cash flows, understanding the depreciation tax shield, understanding what happens when working capital goes up and working capital goes down, calculating that gain or loss on the sale of the equipment. But the good news is, once you understand those few things, there's not many. Once you understand those few things, you're good. You understand it. Any questions, just going to change the numbers. It's going to change the amount of the working capital increase and decrease. It's going to change the amount of how much cash flows we get in each year. It's going to change the amount of the cost of the initial investment. It becomes variations on a theme once you understand how to deal with each of these individual cash flows and how to take into account the tax impact for each of those cash flows. And once you have it, you're good, because it just becomes variations on a theme. And, realistically, first few questions you do, the first few practice questions, it's going to be a little slow. But once you understand how it works, once you understand the system behind it, this just becomes something you're going to be able to do in second nature by the time you take the exam, and that's going to help you get these 10% correct. Okay, the 10% for Section E is based on these cash flows. You're going to be good with it, you're going to be comfortable, confident with it, and you are going to get these questions on the exam correct.